Hi everyone. Today we're going to be providing an updated and expanded snapshot of some ex-China ETFs as of mid-February 2026. We made a similar video about this topic in September of last year, but in this video we'll talk about a few more ex-China options as well as update the data from the previous video. So with that, let's go ahead and get started. And just a quick reminder, this video is for informational purposes only, and it is definitely not investment advice. First, let's talk about some of the more mainstream options. These are the most vanilla options, and they all construct their portfolios without China exposure. They deploy passive strategies, although they use different benchmark indices to make their portfolios. The three we're going to talk about here are the iShares Emerging Markets ex-China ETF, ticker EMXC, the Vanguard Emerging Markets ex-China ETF, ticker VEXC, and the Columbia Emerging Markets Core ex-China ETF, ticker XCEM. EMXC tracks the MSCI Emerging Markets ex-China Index. MSCI has its own country classification, free float adjustments, and size screens. VEXC tracks the FTSE Emerging ex-China Index. FTSE uses slightly different country classifications and index rules, and historically MSCI and FTSE have disagreed on whether certain countries are emerging or developed, as well as how they treat some markets. Finally, XCEM tracks the Beta Thematic Emerging Markets ex-China Index, a less widely known index family. It's still a rules-based and market cap-weighted index, but the construction mechanics differ from MSCI and FTSE. That said, the country compositions and sector tilts are pretty similar, although with slightly different weight. Among the funds here, EMXC has the most assets under management with almost 17 billion. The fund also has an expense ratio of 0.25% and totaling right now 638 holdings. Vanguard's VEXC is the newest fund among these. It's launched in September of 2025. And what might be interesting to investors is that it offers a significantly lower expense ratio at 0.07% as of today, as of mid-February. This is unusually cheap even among broader emerging market funds. Vanguard's approach reflects the broader fee compression trend across ETFs, and the trade-off is that it doesn't yet have a long performance history, as we'll see in a moment. So investors are relying more heavily on the underlying index methodology and Vanguard's reputation rather than an established multi-cycle track record. Another interesting thing to note is that VEXC offers the greatest breadth of holdings among the ETFs that we're going to talk about today, and according to our research, it is the second broadest in terms of holdings for ex-China ETFs with over 1,000, and it is by far the most for a passive ETF, at least that we came across. Finally, XCEM is the oldest of the three, having been launched in 2015. The ETF has 1.5 billion under management, 331 holdings, and an expense ratio of 0.16%. Among these, the sector tilts are all fairly similar, comprised in tech, financials, and energy minerals, but the country composition of VEXC differs from the other two by weighting Taiwan at almost 35% and India at 25.3%, meaning India and Taiwan make up almost 60% of the fund. Performance-wise, the iShares Emerging Market ex-China ETF has slightly outperformed the Columbia Emerging Markets Core ex-China ETF. Given how new the Vanguard fund is, there's simply not enough data to say anything conclusive yet, and you can see the differences in returns for different time periods here, so please pause and take a closer look if you're interested. All of this data comes from ETF database. Now let's talk about a few other alternative, less vanilla options for ex-China ETFs. These are the WisdomTree True Emerging Markets ETF, ticker XC, the Matthews Emerging Markets ex-China ETF, ticker MEMX, and the Putnam Emerging Markets ex-China ETF, ticker PEMX. Among these three, only the WisdomTree True Emerging Markets ETF is a passive index tracking ETF like the others that we previously talked about. It's a rules-based index that excludes China, South Korea, and Taiwan, as well as state-owned enterprises. There's no discretionary stock picking. The fund tracks the WisdomTree Emerging Markets Index and currently has just over 125 million under management. The fund has an expense ratio of 0.32%, making it the most expensive in terms of the ETFs that we're talking about today. The exclusion of Taiwan and South Korea in addition to China also gives the fund a different country composition and sector tilt compared to the others. In comparison, the Matthews Emerging Market ex-China Active ETF is actively managed with the MSCI Emerging Markets ex-China Index as its reference benchmark, not as a strict rule set. The fund actively selects and weights stocks in the ex-China universe, aiming to outperform the benchmark index. Something to note here, however, is that Matthew's prospectus allows for up to 20% exposure to China. Thus, it is benchmark aware but not structurally prohibited from China exposure. MEMX is also smaller than the other ETFs that we've talked about, with around 43.5 million under management and just 87 holdings as of February 2026. PEMX is also active and references the MSCI Emerging Markets ex-China Index as a guideline, but again, the portfolio is constructed based on the team's convictions. PEMX is also a smaller fund with just under 19 million under management and 52 holdings. MEMX and PEMX also have higher expense ratios than the passive options that we just talked about, coming in at 0.79% and 0.69%. With these two, the active process drives both stock selection and sector and country tilts. When it comes to performance, the WisdomTree True Emerging Markets ETF has underperformed relative to the passive ones that we previously looked at. Comparing the two actively managed funds, these perform differently depending on the different time horizons, although Matthews has a slightly longer track record. Again, it's important to remember that active strategies typically carry higher expense ratios, and higher turnover can increase trading costs, which in the end may reduce net returns relative to some of the passive alternatives. So if you're interested in taking a look at the data more closely, please pause the video and take a look here. And that concludes our video for today. Thank you for watching. Please check out Vina Edge for more information on emerging market investing and living. And once again, this is for informational purposes only, and this is definitely not investment advice.